Now, as all of you would have known by now, a full-scale invasion of Ukraine appears to be taking place. In my previous video on my market outlook for the year 2022, I've highlighted that I expect it to be a rough year for the markets, and the Russia-Ukraine conflict just made it an even rougher year. That said, I do want to shed some light on my view on the markets about this matter. A little disclaimer before we begin. Once again, nobody knows if the market will go up or down in the future. What we can do, however, is to work with the facts that we have at hand to form a view based on probability and then position ourselves accordingly. Without further ado, let's get started. Looking at the facts. Now let's start off by examining the past performance of the markets, in this case S&P 500, during times of war and conflict. From the above chart, we see here that the market had registered a positive return 75% of the time, after 12 months of a significant geopolitical or military event like what's happening today. The times when the market provided a negative return is when it was accompanied by periods of recession at some point during the measurement period. That said, we must acknowledge that times are different today as compared to the past. And going back to the topic of valuation, you will realize that in all previous time of conflicts, the market had been trading at a valuation that was far lower than what we are trading at today, both in the measure of the Shiller price to earning ratio as well as your normal price to earning ratio. Now, the only exception to this was during the year 2001, when the price to earning was higher than the value that we are trading at today. And of course, the market registered a negative return of 18% during that period. The implication of the conflict. Now that we've understood the past behavior of the markets during times of conflict, as well as the current valuation environment that we are trading in, what are the implications of the Russia-Ukraine conflict, in particular to our investment portfolio? The immediate implication of this conflict is the impact it has on global inflation. Like it or not, Russia plays a huge role in the commodities market as they are one of the major exporters of gas, coal, petroleum, wheat, etc. That said, the conflict itself is expected to increase the price of commodities, raw materials and finished goods, which will further exacerbate the global inflation situation that many countries are trying to control at the moment. We've already seen a steady increase in the price of wheat and crude oil since the beginning of this year, and this conflict itself will add more fuel to the fire. Now this is important because central bankers, especially those in Europe, run a higher risk of triggering a recession as they try to curb the rising inflation rate problem while balancing between the uncertainties and deteriorating business and consumer confidence. And as what we've seen from past performances, a combination of recession and conflict often result in poor performances over the next 12 months. Personal views. Now, all things considered, my general stance towards the market remains unchanged. As I've previously mentioned in my 2022 market outlook, I believe that the US market has more room to correct, given the expensive valuation that it is trading in. And in this process of the correction in the US markets, the Asia market will also experience further price decrease, given the correlation between these two markets, despite being fairly priced. With the current conflict that is going on between Russia and Ukraine, I think what is likely going to happen is that it will accelerate the pace of this correction, both in the US as well as the Asian markets, and chances are is that prices may trade sideways and stay depressed for a prolonged duration of time after the correction. So the reason for expecting a prolonged consolidation after the correction is because I think the market needs more time to recover fundamentally, given the additional problems and challenges that the Russia and Ukraine conflict may have on the global economy. Overall, I think there's no need for you to be alarmed with the price developments in the coming year, though I get it, right? It sucks to see your investment perform poorly during such times. But remember, the strategy that we are running is longer duration of nature, and these short-term ups and downs will eventually be ironed out as the fundamentals of our investments recover and continue to grow over the next 5, 10 and 15 years. Next steps. For my dear clients, as the market continues to correct, I will call for additional funds to buy the dip as I've previously briefed you guys back in December last year. So no action is needed for now, and there's really no need for you to worry too much about your investments, as I am here to help you manage and navigate through times like this. If you have any concerns about the market or if your financial plans have changed since we last spoke in our annual review, please sound out to me and we can schedule a meeting to run through your financial plans once more and ensure that the investment portfolio is aligned with your overarching financial plans. For non-clients or clients who is currently not investing with me, if you do not have the time, knowledge or interest to manage your investments, you can check out what I do on my website to see how you can benefit from my investment planning services and reach out to me directly. If you found this video useful, do drop me a like and subscribe to this channel to stay updated with the weekly upload. Stay safe and I hope to hear from you soon.